On this week's episode of the podcast, From Taxes to Treasure. So, welcome back to this week's episode of the Crushing Debt Podcast. My name is Shawn Yesner, owner, founder of Yesner Law. I am joined again in studio by your financial coach, George Cabello. How you doing, George?
I am doing well. I have to say, we've been talking, back to school and all these routines and everything like that. But then I started realizing, oh my gosh, my kids are expensive. My kids are expensive. But everyone's doing well. And I've got two seniors, right? One in high school, one in college. So of course, everything is graduation. Everything is got to get this, got to get that. Dad, I need a new dress. I need this. But I'm like, okay. So yeah, I'm budgeting a lot more. That whole save a month, month of savings and all those kind of challenges we have. Yeah, they're getting, impacted because I got to make sure my girls are all happy for their senior year.
I finally got my tax returns filed.
Nice.
So I got my refund in the mail not in the mail, in my bank account the other day. So now I've got to figure out, what am I going to do?
Ooh.
Are we going to go do something fun? Am I going to pay off some debt? What am I going to do?
Are you going to be responsible, or are you just going to say, YOLO? What's going to?
So one of the first things I did, because I've done this every year, if I get a big return and I see that the following year, the current year is going to be the same as the year before, I adjust my withholdings.
Oh, that sounds so boring. What's wrong? What's wrong with you?
What it does is I withhold less,
right?
Which means I get more in my.
That's true. That's true.
Now I don't get as big a refund, but I get more in my take home.
Yeah, makes sense.
We'll see.
Nice.
I'll probably treat myself to a bottle of something for.
And the boys are probably going to ask for something, so that's typical too.
I tell the boys I got the refund.
Oh, well, now they know. They kind of listen to the podcast, right? There you go.
So we've got a guest on this week's show. So I want to get to our guest. I'm real excited to talk to him. It's today's show is going to be all about investing in tax deeds, which we've done a couple times before, but it's always great to get additional perspectives, additional knowledge. It is something that we've done here. Plus, and we'll talk about this as well, but here in Florida, if you're listening to the show when it comes out, you should have received in the last couple of weeks what's called your trim notice, which stands for truth in millage. Millage is how property taxes are calculated. And so the property tax collector sends out a letter around August every year in Florida that says, here's what we anticipate your property taxes will be next year. This is also the time, if you think your property taxes have not been calculated properly, this is also the time to challenge that with the tax collector, tax appraiser. When the tax bill comes out, it's too late. When we get to January, February of the following year,
it's already filed. It's ready to go. Yeah.
So if you want to challenge, maybe you your property did not go up in value as much as the tax collector thinks it did. Maybe it dropped in value because it was damaged by the hurricanes or whatever.
Right.
Now's your opportunity to challenge the tax value if you think that's appropriate. But we're going to talk about tax deed investing. So I want to introduce our guest, a visionary leader and a founding partner of Last Best Partners, as well as the founder and CEO of Tax Sale Resources and several other portfolio companies with a strong background in systems engineering and an advanced understanding of the tax sale industry. He's been instrumental in transforming the way investors access tax lien and tax deed information. His expertise in designing and programming enabled the development of a comprehensive online platform that we're going to talk a lot about, that not only delivers accurate tax sale data, but also effectively tracks investor needs, setting a new standard in industry due diligence and efficiency. Welcome our guest, Brian Seidensticker. Welcome, Brian.
Well, thanks, gents. Shawnee made me sound a lot better than I typically feel.
I'm just reading what your website
Had a good marketing person put that together.
Yeah. So, tax deed sale, I guess the first question, and we talked about this a little bit before. Before I get there, the website is taxsaleresources.com. So you can go,
yes.
and I've just been poking around that website a little bit, but it's got a ton of information. My first question to you, which is kind of what we talked about pre-recording, was this is a nationwide company, correct?
It is. We track about 9,000 different tax sales, nationwide, around 2 million properties that we process through our due diligence platform. And it is nationwide. I mean, there's some areas that are maybe a little sparse. There's not a whole lot of activity through us in like Alaska and some of the territories, but in general, we track at least to our knowledge the most comprehensive data set nationwide.
And it's data for people that want to invest in tax deed properties, right?
It covers both tax lien and tax deed sales, which are different in different kind of profiles looking for each of those. The tax deed guys are really real estate investors. It's just another avenue of acquiring property. And, tax lien investors are typically passive. I call them micro mortgages. If from a mindset standpoint, you buy a note, you kind of wait, you earn an interest, and not nearly as active. Now, it's certainly still a decent amount of work to do it right, but not as active as property. So it covers both ends of the spectrum.
Yeah, and you touched on it a little bit, but I do want to get into the differences between investing in the tax lien versus investing in the tax deed. So I understand the difference.
Yeah, I was about to say for the layman person on the call, could you, can you say what is a tax deed and the difference in lien? Can you just, give me the very high level kind of view of this, please? Thank you.
Sure. Yeah, I think it helps to kind of describe the process a bit because
Mhm.
and I think it makes more sense of what the heck the difference between a lien and a deed, and then there's each state is different, and there's a couple iterations that are somewhat a little bit of both. And so I think just understanding the whole distressed or delinquent tax process helps. And because most people don't even think about it, because most people pay their property taxes, but there is the mechanism in place, which is really the enforcement and the payment of property taxes that they had put in place a long time ago. I don't even know the date. Probably something I should know, but way before I was born.
Right.
And what happens if you don't pay your property taxes? And that's the start of the process. And so to caveat that with each state is different, right? And you
Mhm.
guys are in Florida, so I'm gonna kind of describe how Florida works, right? And that covers most states, to some level, the difference between a lien and a deed, and then, kind of the mindset of an investor in those. But the first thing that happens, when you don't, let's say when property owners don't pay their property taxes, is if one person doesn't pay their property taxes, not a big deal. But in some areas, it can add up to be tens of millions of dollars of unpaid property taxes, and that amount of money is very significant because those tax dollars go towards paying for teachers in schools. It
Right.
paves the roads, it pays the policemen and the firemen, and so the county, typically the county, and I'll call it jurisdiction because sometimes it's at the city level. What the county does is they're looking for ways of collecting that unpaid balance, and so that they can pay their bills. They need to pay those teachers, et cetera. And so what has been put in place is this tax lien mechanism. And basically what the county does is goes out to private investors and says, hey, I've got $10 million of unpaid property taxes. If you essentially lend me the money that is due to me, right, the $10 million, and it's usually at the property level. So let's scale it down a little bit, $1,000, right, for unpaid property
Right.
tax. If you lend that to me, there's going to be an penalty interest for that property owner and the vast majority do pay their property taxes at some point, just late. When they do pay their property taxes, instead of me, the county, collecting that penalty, I will turn that over to you as the investor. That's really how the investor in the tax lien makes their money. And so it makes the county happy, right? They get the unpaid taxes that are due.
Right.
It makes the investor happy. They get their return, right, at some point down the road. And the community is typically happy because they get their roads paved, they get their teachers paid, right? The schools are operating. And so it's a pretty cool mechanism that allows counties to balance that shortfall at the end of the day. And that's really the point in which a tax lien investor comes in, right? I like to compare it to a micro mortgage, only because the mindset is similar. You don't own the property, you have an interest in the property. The lien that is recorded against the property gives you, as the lien holder, the right to enforce that, right? And I'll talk about that next through the foreclosure process. but you don't have rights. You can't go in and remodel the property. And I think there's a lot of misinformation out there, or misunderstanding probably, of you can't just buy the taxes, go flip the property and make $100,000 and $1,000 investment. That just doesn't exist. Now, what happens, again, back to most property owners will pay their property taxes eventually. And they'll pay that penalty to the county. The county turns it over to the investor, and the tax lien investor's happy, right? They didn't have to do anything. But there's a small percentage that don't end up, small percentage of property owners that don't pay their property taxes. And so what happens is the investor in that scenario that has his lien, right, just like a mortgage, can start a foreclosure process. In Florida, it's called a tax deed application process. That starts a foreclosure process very similar to mortgage foreclosures. The biggest difference being, typically, if you don't pay your mortgage right within a month or two, that process is started. But in taxes, it's usually years, right? And again, in Florida, it's at least 2 years, can go up to 7 years. In some states, it's 5 years. It varies, but it's multiple years later that they give the property owners. But if they don't, there's a foreclosure process. Sometimes it's administrative, done by the county. Sometimes it's judicial, meaning it's done by the courts. But either way, what that culminates in at the end of that auction, or at that foreclosure, is an auction, just like a mortgage foreclosure, where the county or is selling the property, right? And that's the tax deed, right? That you're no longer buying a lien on the property. It's not just interest. You're actually buying the property, right? And so these types of investors are much more active, right? With more potential return, but also more headaches, right? You got to mow the lawn
Right.
now. You got to make sure the property doesn't get demoed. There's a lot of stuff that comes along with it. But with greater risk, typically, is potential greater reward, right? And so the tax deed end of it is usually for folks that are willing to take on that risk, want to be much more active, just like a proper any other type of property investment. So that's really, it's not really a short answer, George. Sorry, but I think it's a good to understand the whole process from start to
Let's
finish.
yeah, got a better picture.
So do you, I assume you have data on all the different types of tax deeds or tax liens that there could be. And what I mean by that is residential versus commercial,
Right.
vacant land versus developed, a piece of property with a building or a house or whatever on it. And I've even heard of some tax deed investors or tax lien investors that focus on those strange shaped. So you got like a thin piece of property between two residential pieces of property, and nobody really knows who's supposed to be paying the taxes on it. So that, strange shaped piece of property gets sold and someone buys it. Your website would help with anybody who, if anyone is focused on any of those different types. Is that correct?
Correct. Yeah, it covers all, but you kind of hit the nail on the head with, the counties don't really do any sort of filtering, right? And when it's like, most people look at their house like a parcel, don't even think about it. But when you look at a whole county that's parsed up by all these boundaries and lines, you end up with these weird shapes in certain locations, and that can be where, you mentioned some people target those weird shapes, with a very unique investment strategy, and some people just don't have a clue that, hey, and I've seen it, right? You can buy a tax lien on a parcel that ends up being literally a mailbox or a chunk of sidewalk, or I've seen, where it's just the road in a new development, right? And unless you have a strategy for what to do with that, you can end up buying a lien on a chunk of land that ultimately has no value. And so, what do you enforce? And that's we're kind of maybe getting a little bit of the cart ahead of the horse here, but that's usually the biggest risk, is people not actually looking at what they're buying. There's no guarantee that you're going to earn something at some point, right? And so you do need to do your research before you buy that sort of stuff.
Right.
There was a guy here in Florida. I think he's since passed away, but there was a guy down here in Florida that used to target those weird shaped properties. And I know what he did once. He like bought the land that was around a lake. So there were a bunch of people that lived in this community, and they all had a lake view, but their property line stopped at a certain
Yeah.
point, and then there was a piece of vacant land between their property line and where the lake started. And so he would buy these weird shaped properties for, whatever, $1,000, $2,000, whatever it is. And then he would put up like a pink fence and say, if you want me to take down my fence, you got to pay me $1,000. And so he would buy these properties for $1 or $2 or $3,000. But if there's 20 homes on the lake and you get $1,000 per pop to take that section of the fence down, he turned a $2,000-$3,000 investment into 20 grand, 25 grand, 30 grand. Now I think Florida's come in and put in laws that would outlaw that kind of stuff. But and
that gotta be mean as well. Like, you know.
Well, and the guy was all over the news.
Right.
He wasn't a very the impression that the media made was that he was not a very good person.
Yeah, you're not making any friends doing that sort of thing.
Yeah, that's what I'm saying.
But who needs friends if you got a lot of money?
I guess that is a theory. That's not one I would recommend as far as from a long-term standpoint. But there's, I've heard similar, but I've heard guys buying the deeds on the road, right, in the development, and they'll go in and put a barrier, right. I guess legally, maybe they do have the right to say, hey, it's my property, right? If you want in, you got to pay me a fee, right? Like a toll road. But I guarantee there's not a single person in that development that likes that individual.
Right.
So I like to say, shy away from those approaches, right? There's lots of ways to make money in tax deeds without taking that level of extreme. But there's certainly folks that have been, I'll say, very creative in their disposition.
Creative is a good word. Yes.
Yeah.
A good word.
So, but let me ask them, what's the, when we talk about the returns, right? Is this like, people always look for the get quick, get rich quick kind of thing, right? With this type of investing, like, what's realistic when it comes to returns? Like, is there something that, we need to really keep in mind when it comes to this type of investment?
Yeah, I think, and I'll say I'll start with the tax lien side of it first, and it's a good question, right? And the short answer is it depends.
Yeah,
I
love that answer.
I think if you look at it, very high level, right, and you say, hey, institutional investors that want to enter the space, which you can on the tax lien side. There's actually, banks that will lend on tax liens, and you can invest, I know some of our customers invest upwards of $100 million a year in tax liens, right? You can do it on a large scale.
Mm-hmm.
The type of return you're going to get at a scale like that is really going to be a 5 to 7%. And it varies, right? With it follows the Fed rate because that's the source of the money at the end of the day. But that type of return for tax liens at scale is on average. Now, if you're not looking to place $100 million and you're got let's say less than a few $100,000, there's certainly approaches where you can make mid-teens, right, with a couple $100,000 if you buy right. And I'm going to use Florida because I love using Florida as an example. Each county has their sale in May and June each year. And the way the sale works is you have to put a deposit down, and then you can, I think it's like 5 or 10% deposit, but then you can bid up, right? But there's inevitably going to be some people that just don't have enough cash to buy everything they just purchased. And so what the counties do is they have, I think they call it a cleanup sale. I don't know, they changed the term, but right after that sale, for the stuff that people bought and just couldn't pay for, they put out really through a first come, first serve basis. And the advantage of that first come, first serve cleanup sale is you're getting it at the statutory maximum, which is 18% in Florida. And so as long as you're not buying the junk in that cleanup sale, you can still get a good return on those liens. Where typically the way the lien sales work in Florida, you're bidding down that interest rate, right? We're getting into specifics, but people bid that down to less than 7%. And so what you're making typically is much less than that. Now there's not gonna be $100 million of those, right? There might be a few $100,000 of those, right? And you got to be on it because it's first come, first serve. But the opportunity is there at a smaller scale. That's on the lien side, right? The kind of the two extremes. And then depending on your model and the type of property you're after, et cetera, you can make anything in the middle of that. On the deed side, I'd say the risk is higher, right? Because you can buy a property and then lo and behold, it's again, I like to use Florida. Counties like to slap a $500 a day fine for not mowing your lawn. And after 3 years, that adds up to a pretty significant fine. And yeah, you might have thought you just bought a great property, but now you have a $30,000, you didn't mow your lawn fine now. And you can work that out with the county usually. But the risk is higher. But on the flip side, if you know where to buy, what to buy, right, the return can be immensely higher as well. Again, I'd say on average, right, a 10-20% return is pretty common with tax deeds. But if you know what areas to go into, what properties to target, and you have the right model, you can make multiples of your money on an annual basis. So it's, high risk, high reward.
Yeah, I want to back up a little bit and talk about, and I know this is how it works in Florida. I assume every state is similar, but again, like I said, typically August is when the trim notices come out to tell you what your taxes or your tax bill is going to be.
Mm-hmm.
Tax bills come out in October. They're first due in November, and if you don't pay, it's a lien for the entire year. So a tax bill that comes out in November 2025, in a couple of months, if you don't pay it, it's a lien since January 1 of 2025 against the property.
Sure.
You get I think it's a 3% discount if you pay in November, 2% discount if you pay in December, 1% discount if you pay in January, and then no discount if you pay in February or March. And then I think in May is when they sell off, May or June is when they sell off the tax certificates for property taxes that are not paid. And then those have to mature for 2 years before you can apply for a tax deed sale. So somebody that doesn't pay their 2025 taxes, they may not be in danger of losing their property until 2028.
Okay.
Because the lien is issued in 2026, and then 2 years later is 2028. They can apply for the tax deed sale. And something else, Brian, that you said was interesting that I want to expand on a little bit was this idea, which it took me a while. I understand it now, but it took me a while to understand. In a foreclosure sale, the investors bid up the judgment amount. So bank has a judgment for 100,000, but if the property's worth 400,000, you're going to get bids of greater than $100,000, and the investors are going to bid up to fight for it. Tax deeds kind of work the opposite way, like you said. People bid down the interest rate. So it starts at 18%, and an investor will say, well, I'll take 17%. And another investor, I'll take 16. And then another, I'll take 15. And do you know why? I mean, again, I know, but you're the guest in the show, so I want to highlight you. Do you know why we bid down the interest rate? Can you talk about that a little bit more?
Yeah, and I'd say that I think the minor clarification I'll make is on the tax certificates or the tax liens is where that bid down method is used, right? When the foreclosure of that through the tax deed application, the sale of tax deeds, I'm gonna hesitate on it because there's probably a listener out there going, he's wrong. There's a state that doesn't, but I'm not aware of a state that has anything other than, I'll say, the traditional bid up method for the real estate itself, right? Hey, the opening bid's 10,000, 20,000, etc. On the lien side, I guess we're, to get a little bit into politics, it's a bit of a push and pull between groups that are I'd say advocating for the property owners, right? And saying, hey, this is what's fair. And this is, and then those are like, well, that doesn't make sense for investors. Why would I, buy a lien that doesn't earn anything? And that is probably that method of bidding is the biggest thing that varies from one state to the next, right? Florida is a bid down interest level. There are states like Colorado where you're bidding up what they call as a premium, right? So the lien amount might be $1,000, and you're going to bid $100, $200, for the right to own that, but you're only going to earn 10% on the lien amount, and so that extra premium is kind of sunk cost, and so you got to add that into your calculation, right? So it varies, but it really comes down to the argument of trying to be something that is worthwhile for investors and what is fair to taxpayers. And so like in Florida, if it's bid down to 0.25%, I think is basically the lowest bid you can place in Florida, that is essentially the penalty that homeowners are paying when they do go pay their property taxes at some point in that 2-year period, right? And actually in my theory, that's probably one of the reasons why Florida has one of the largest volume of unpaid property taxes, because if you own a property of good value, the chance of that bidding down to 0.25% is pretty high. And so a lot of people use that as a very low interest loan, right? If you have a very high value property and your property taxes are 50 grand, where else can you get a 0.25% loan on 50 grand? Now, that's a weird way of keeping 50 grand in your pocket for 1/4%. But there's a ton of people out there in Florida, and we've seen it in data, like they will let their properties go delinquent, and at a month before that 2-year period where the tax deed application could be applied for, they pay their property taxes. And that pattern is just unique in that why else would you do that every year unless you were doing it intentionally?
It makes no sense to do that every year. The way that it was explained to me is very much what you said, in terms of it's this conflict between Florida very much values, as I'm sure every state does, but Florida with its unlimited homestead exemption puts a big emphasis on people, your residents of Florida, being able to live in their house without worried about somebody coming and taking it away.
Right.
But it's the conflict between that and you need to pay your property taxes.
Yeah.
And we don't want people to lose, a $500,000 house over $20,000 of unpaid taxes, $50,000 of unpaid taxes, whatever it is. We don't want someone to lose $150,000 house over $1,000 of unpaid taxes.
Right.
And so it's that constant conflict between where the Florida legislature says, and I'm sure this applies at some level in every state, the legislature says we want our residents, our citizens, to be able to own houses, but we also want some mechanism to force them to pay their property taxes.
Yep. Yep. I think that's spot on. And I think that constant conflict between the parties is what's healthy, right? I think there's got to be incentive for somebody to come in and pay the delinquent taxes, right? That's the investor side. And there certainly needs to be proponents on the homeowner side of saying, hey, don't make this detrimental to the ownership of a property, right? And there is a happy medium in there, and I think the bid down method is a good way of defining what that happy medium is, because it does vary, right? When interest rates were at near zero, Fed rates, then that happy medium was lower, right? People were willing to bid down a little lower than today, where that Fed rate is a little higher, right? Because the game that the institutional players are playing is that spread, right? If they can buy liens at 8% and they only have to pay 4% on their money, right? They're making that gap. Well, as that 4% of their money goes down, they're willing to bid down because they're just looking at making that 4% gap. So it's a good and fair method for establishing that happy middle ground in a market where it varies, right, one year to the next.
Yeah. So I'm poking around the website again, taxsaleresources.com. I'm poking around the website. You've got a ton of resources on there. You've got a state directory that has different information about the different states and how they handle tax liens, tax deeds. You've got investor news, newsletter, help center. You've also got a podcast, which is the Tax Sale Insiders podcast. And looking at that, that's available wherever you're listening to this show.
After you listen to this show, you can.
Also, the blog. I thought the blog was really interesting. One article that I picked up on, I guess Rachel is your sister, is that right?
She is, yes.
Okay. So she wrote an article. So see how well you know your own blog. She wrote an article which kind of appealed to me because it was a Supreme Court case, Tyler versus Hennepin. Understanding the fallout of the Tyler versus Hennepin saga, which I guess is being kicked around or has already been decided in the U.S. Supreme Court. But it had to do with it just from reading your blog, so it's how much information you've got in your blog. It had to do with how the owner of the property gets any surplus funds, or in this case, didn't get the surplus funds. So whatever after the property was sold at a tax deed, it was sold for more than what was required to satisfy the tax lien, and there were surplus funds available. And I guess it went all the way to the Supreme Court because in this particular case, it was Minnesota that it looks like said, thank you very much. We're going to keep the surplus.
Ooh.
Yep.
And the owner in the U.S. Supreme Court came in and went, no. You can take the property away with a tax lien and a tax deed after that, but you can't keep the surplus funds.
Exactly. Yeah.
Wow.
Yeah. It's a very large topic. We could probably sit here for a whole season talking about the background on that case and the ramifications. But at the end of the day, the Supreme Court made in my opinion, a very right choice in plugging this gap, because what had happened in some states where there was two things in my mind that were wrong. One was there was no secondary auction for the real estate. And so in some states, and it's really been eliminated, in some states you could buy the lien and then multiple years later apply for the deed. And in theory, you could end up owning the property for the original taxes due and whatever interest. But it still is a fraction of the value of the property. And nothing, was provided back to the previous owner. And that, I guess, that mechanism is not fair to previous. Like, if you think of eminent domain, nobody likes eminent domain, but at least when it's put in place, there's compensation to the property owner. And really, what the Supreme Court decided, which in Michigan, or sorry, in Minnesota, it was a slightly different scenario where instead of the lien holder, getting the deed and then being able to do what they want to, like in Colorado used to be that way. In Minnesota, it was the county that foreclosed on that lien, essentially took ownership of the deed, sold the deed. And so if they were paid, let's say, a total of 20 grand with the back taxes plus court fees plus attorneys, whatever, and they could resell that property at the tax deed auction for 50 grand, right? They would keep that $30,000 spread because they claim that, they're the ones that foreclosed on that lien. They own the property, they just resold it. And the Supreme Court said that's not okay. That's a taking, right? That's just a process that was put in, although legally it's not constitutional. And the previous property owner is the one that should have access to that 30 grand, not you as a government. And I think that was a very smart decision because it's bordering on the edge of government starting to make a profit center out of this, not just recovering their taxes, what they're due, making more than that. And that's, I can't remember which judge had stated this, but he basically said, what's due to Caesar, is paid to Caesar, nothing more. Meaning, counties, you have a right to collect what's due to you, but you can't make a profit center out of this.
Right.
And that plugged in that, I guess the ramification of that is it plugged that gap. So a lot of states scrambled, right, to change their laws to make it constitutional, where you can no longer buy a lien in some of these states where and then end up owning a deed without having that lien go through an actual auction, right? And so there's no way of owning properties for pennies on the dollar through that method. Like there's a lot of gurus, using that from a marketing standpoint of, buy taxes, own properties. And although that wasn't untrue, it was a very small probability, right? But it was also not fair to the previous owners of those properties.
Right.
Anyway, again, I'm not really good at short answers, Shawn and George, but that's a kind of a summary of the Tyler Hennepin.
Just it caught my eye when I was flipping through the blog, but the interesting thing that brings up is in a foreclosure scenario. So I borrow money from Bank of America to buy my house. In a foreclosure scenario in Florida, if I were not to pay Bank of America back and Bank of America were to foreclose, and let's say I owed them 200 grand, but let's say my house sold for 300 grand at the foreclosure sale, I can apply for that $100,000 surplus.
Right.
But in a situation where, let's say, nobody bids on it, it's a $200,000 judgment, nobody bids on it, the bank takes the property back. I have people ask me all the time, if the bank ends up selling that house for 300 grand, because that happens to be fair market value, do I get the extra 100 grand? And then at that point, the answer is no, because the bank bought it at the foreclosure sale, and now the bank owns it, and any profit they make on the sale, they make on profit on the sale. The only thing that occurs to me is, I think the difference here might be that in a tax lien or a tax deed scenario, even where the county's involved, it's the government that's doing it. And so the government can't take away without due process. But if you make a private contract with a bank and you don't pay pursuant to that contract, although I wonder, it might be something to kind of look into to see if the precedent that the Supreme Court set might apply to private foreclosure sales. My guess is no, but it'd be interesting to dig into that case a little bit.
Well, if there's anybody from the Pacific legal group that I guess lobbied on or was counsel on behalf of the property owner and that Tyler Hennepin, they may be scratching their head going, you might have something there. I think the biggest thing that, at least on the tax side, that they wanted to implement was there was no opportunity for that foreclosure auction to go unsold, right? In the states that they claimed, it was unconstitutional, there was no auction. It's one thing if it goes to auction and nobody buys it, but in these states there was no auction, so there was no ability for that overage to be generated. And I think that's the biggest thing that is right. I mean, I think it's different if the property goes up for auction and nobody buys it at the tax deed auction, which does happen, right? And then if the county, now it's the county's problem, right? If nobody bought it, typically there's a reason why. But it's very different if there's just no opportunity for anybody to bid on it, right? And then the county is taking that, profit in for themselves.
No, that makes sense. And again, I've seen scenarios where tax deed investors will buy the lien, but they know they don't, or maybe they do their due diligence after they buy the lien. They do their due diligence and they say, I don't want this property back, so I'm going to sit on the passive investment and see if somebody pays off my lien. But then what happens is the next year taxes go unpaid, another lien, somebody else may buy another lien. And I've seen scenarios where tax lien investors say, you know what, it's part of the risk of investing. I don't want this property, so I'm just going to let my lien go. I'm not going to force it to a tax deed sale because I don't want the property back.
Oh yeah, I think that's I'll say the expiration period back to Florida, right? 2 years is the minimum amount that you have to hold that lien before you can start the tax deed application or the foreclosure for the tax deed. But you can wait up to 7 years. And so there are, many investors that, hey, they don't want to own the real estate, right? So if the property owner happens to not pay their property taxes in those first 2 years, they won't do anything, right? They don't have to do anything for up to 7 years. Now, at 7 years, you should do something. Otherwise, it expires and you can't do anything about it. But they really wait as long as possible before they do any sort of enforcement, just because they don't want to deal with that end of the spectrum.
Well, because if you buy a tax lien now and you sit on it for 5 years because you don't want the property back, but somebody that gets a tax lien 5 years from now, somebody wants to pay off that tax lien that's 5 years from now, they got to go all the way back and not only pay off the one that's 5 years old, they got to pay the one that's 6 years old. They got to pay the one that's 4 years old. They got to pay the one that's 3 years old. So they got to pay them all. So it could be kind of a long game for real estate investors.
Yes, yeah, it can be a very long game for some investors for sure.
So, any other questions for Brian?
I think the only other one is, we have information that's out on the web, things like that. But is there any other, tools or resources you would recommend for folks who want to kind of deep dive into it? Obviously, go to your website, get you there. But is there anything else?
Other than taxsaleresources.com and the Tax Sale
Right.
Insider podcast.
Exactly.
Yeah,
What would you recommend?
I think for folks that are looking to get into space, we're not a coach, right? We're not, that's not a service that we provide. There are, folks out there that are coaches and they have coaching programs and educational and there's good ones. And I'd say they're all good. It's just some are less expensive and some are very expensive. And then I would always highly recommend looking at the marketing material with those. And if they're, making statements of owning properties for pennies on the dollar, like in theory, that's not wrong, right? It's not false, but don't go into it with that as a model, right? That is so small probability that it's not a good plan.
Gotcha.
If you're self-motivated, right, you want to learn yourself, I'm biased here, but we have so much free information. If you're willing to read the blog, listen to the podcast, watch the video. I mean, I interview attorneys in multiple states about how the process works in that state, and we get very nitty-gritty or details of it's borderline like great information, and also if you listen to it right before bed, it's probably pretty good at putting you to sleep. But it's great information if you really want to know how. And, it's hey, you want to listen to an hour podcast, or do you want to spend $1,000 engaging an attorney to get that level of information? So there's lots of and I highly recommend anybody to do their research before they just dive in.
Right.
A lot of people can get lucky, right, diving in, but if you don't do your research, you will eventually get burned. I guarantee it. It's just a matter of when, and it's better to avoid that from the beginning.
Excellent. Always something to learn, man. I'm telling you.
Always,
It's
always.
it's a brilliant podcast that we have here.
Absolutely. Well, Brian, we do want to thank you for being a guest on this week's show.
Well, thank you guys for having me. This is fun. Maybe do it again sometime.
Nice.
Yeah, absolutely. I also want to mention the Patreon page. So you go to patreon.com/crushingdebt if you want to help us fund our tax lien investment. I'm kidding. It all goes back into the show. But yeah, go to the Patreon page. There's behind the scenes stuff over there. We've got a bunch of interviews coming up for everybody in the coming weeks. Again, check out Brian's website. It is taxsaleresources.com. Other than that, anything else?
I'd say, guys, let's just save a little and enjoy the weekends. That's what I'd say. We work hard. We might as well enjoy it too.
So by the time this episode comes out, we will be beyond the Labor Day weekend. So
yes.
Enjoy your Labor Day weekend. Hopefully, I will be in a good mood following week 1 of college football.
No guarantees there.
You're up in, Brian, you're up in Ohio?
Yeah, I live in the Cleveland, Akron area.
Okay, so any particular school you're going to be rooting for?
Well, I grew up in Montana and I went to Arizona State, and so Arizona State Sun Devils were a little bit of a Cinderella team last year, but we're pretty excited to watch them this year.
There you go.
So you want to
Go Sun Devils.
You want to see how much of a fanatic I am. Arizona State's head coach, Dillingham, was it Kenny?
Yep, Dillingham.
Kenny Dillingham was the offensive coordinator at FSU for a little bit.
Okay, then. Yeah. Did not know that. So that explains a lot. Just put it like that.
Some good stuff. Well, he's a grad Arizona State grad, and then he kind of went off and I'd say learned the ropes. And I'd say I didn't realize he was at Florida State, but he learned some great stuff because he's made an immediate impact, a great impact at the program. It's been
nice.
Fantastic.
There you go.
Watch.
But yeah, no. So I think we're both. And Arizona State is. I know Florida State's garnet and gold. Arizona State is what, red and gold?
Maroon and gold. Yep.
Maroon and gold.
Yeah.
Okay,
What?
Get it right.
Share a comment. At least there's no orange or blue in Arizona. I can root for Arizona State without any orange or green or blue in there.
There you go.
So anyway, we'll stop talking about that. This week's episode is about. But again, thank you, Brian. We really do appreciate you being on the show. And again, tax lien investing, tax deed investing should help you to have more money at the end of the month rather than month at the end of the money. And we will talk to you in next week's episode.